Yeah, it's very clear that markets are continuing to trend higher despite where valuations are. We're marginally underweight risk assets at the moment. And to us, it's very clear that asset allocation and currency allocation will be the biggest drivers of performance going forward into Q2 and beyond. The problem we've got with Q2 and also future quarters for 2021 is that the earnings numbers just look ridiculously optimistic. You've got revenue growth of around 9 to 10%. You've got earnings growth in the order of 24 to 25%. And in fact, the Q2 numbers are very aggressive in terms of expectations, and these are all off a low base. Consequently, you get lots of enthusiasm, lots of money going into the marketplace, reflected, as I've already said, in the bull-bear ratio at a 3-year high. And this is probably a time to just be a bit more prudent and a bit less optimistic about where markets are going. And our view here is if markets do continue to rally into Q2, we're more likely to take risk off the table than actually allocate more risk to the table. The other factor to consider, Jeff, is obviously what's going on with the US dollar. The US dollar did sell off at the beginning of this year, but from our perspective, we've seen a little bit of strength. We believe that the US dollar will continue to weaken towards PPP levels going forward. Now, versus the euro, we're 16% overvalued. Versus sterling, we're probably now at fair value, but we're expecting to see a little bit of dollar strength. So for those dollar portfolios, we'd be more likely to hedge exposure back to US dollar base as we see the currency strengthening. And then you've just got to make the right calls in terms of sector allocation and geographical allocation. And as you know, Jeff, we are neutral the US, we are underweight Europe. We are now at neutral in terms of the UK, and we are overweight emerging markets and China, primarily because we believe in the reflation story over the longer term. And that's kind of where we're positioned at the moment.
And just to make things slightly more complicated, given your position on technology that's primarily focused in the US, I would guess, how do you feel about Chinese technology, given how much of a pullback we've seen in prices around additional regulation?
We really like US technology, bar its valuation. So we're not overweight in that space. But in China and in emerging Asia, we are overweight technology in that space. Now, there have been issues around anti-monopolistic government intervention in that space. We've obviously got renewed political tensions with the US that we have to be sensitive to. And of course, we have the stronger yuan as well. But that said, valuations look a lot more reasonable in China. You've got forward PEs at 12 times, and we like that space. And it will be the biggest beneficiary of the reflation trade that we've already mentioned.